think if you look at, share, it's okay if equities go up, but the concern would be if property prices and if other real assets which are required in life continue to go up, then you sort of price out the younger generation. So do you see a mechanism where they can actually somehow keep liquidity running, add QE while keeping the stock market going without? Yeah.
Well, I think that's. I think all those things are that's a difficult call for sure. If you take a look at this chart, this is showing the change in the bias of policy stimulus in the US. Now, what this is showing is all forms of liquidity stimulus that go into the markets. So the dark red area is straightforward QE by the Federal Reserve. That's balance sheet expansion. In other words, that's normal open market operations. The orange area is what we've labeled not QE. Now, that is the more subtle element of sort of sous la table deals, which are not headline operations, but things that are more subtle, but they get liquidity into the system, through the back door or whatever. And that is things like, the bank term funding program, the reverse repo tranche, things like the operating losses the Fed is making, things like movements in the Treasury General account. All those factors are the orange line, the orange area. And then the black is the change in Treasury policy in terms of funding. So this is changing the tenor of funding. In other words, shifting the calendar towards Treasury bills and very short dated debt and away from longer dated coupons like 10 or 20-year coupons. So this is basically suggesting that what you've got here is a liquidity expansion because of the big bill increase in bills as that black area. You can see that is the dominant part of stimulus through 2026. Stimulus is not going away. I mean, it's interesting to note that if you look at those cycles, the period from maybe early 2025 was seeing a dip in that pace of that stimulus. And that may well attest to the economy being soft right now or having a soft spell. So it could well be that the real economy picks up. And the point I'm really making here is that, we can debate where the orange and the red tranches of liquidity go, and they probably almost certainly go into the financial markets. But the black areas tend to go into the real economy. And, what you've got here is in terms of the net bias, there's a lot more liquidity going into the real economy. Now, this may well help ease the wealth divide, but it comes at a cost of the financial markets. And I think it's very difficult for Scott Bessent et al. To ride two horses at once. So I think they either want the real economy going or they want the financial markets going. And, the point that I've frequently made is that, all money that's anywhere must be somewhere. Okay. If it's in the real economy, it's not in financial markets.